And then profit number 4 is called principal pay down. Every that's a dot up there. Every house, when you have a mortgage, it's comprised of principal and interest.
Yeah.
Okay?
Mm-hmm.
Now what happens is, the principal portion of the house, let's say it's a 40-year amortization.
Mm-hmm.
So every year, 1/40th of your house is paid off by the tenants. Until 40 years later, this house is yours, free and clear. Now, of that principal and interest that the tenants are paying, and you're paying the mortgage,
Mm-hmm.
it's a rule of thumb. Approximately 25% of the mortgage payment is principal, and approximately 75% of the mortgage payment goes to interest.
Wow, that's huge.
Until that's how it starts at the beginning, and then it
Yeah.
starts to curve the other way.
Okay.
And it switches, but that's at the end of the last 5 years. Principal
Wow.
becomes 75%, and
Yeah.
interest becomes 25.
Okay.
So that's why the cool thing is, and this interest right here,
Mm-hmm.
this is the great part about being a business owner. You have tax benefits. So this interest right here, and all the expenses associated with this house, the property tax, the utilities, the repairs and maintenance, the property management, insurance, you can write them off as a cost of doing business.
And that's right off like against your
Income.
Like, okay.
That's
you'll
right.
pay. Okay.
And you
That's
get to write it
cool.
off.
Yeah.
And because the mortgage, the interest payments, is a cost of doing business, you get to write all this off as well as an
Oh, wow.
expense.
Yeah.
That's right. And there's an additional benefit. We have something called depreciation.
Mm-hmm.
Okay? Now, in accounting terms, depreciation is known as capital cost allowance. And what they do is, capital is like asset.
Mm-hmm.
So your house, the government will actually allow you to depreciate that. Talk to your accountant. It changes every year, the percentages.
Okay.
And the last that I remember, 4%. So if this is like a $100,000 house, 4% is $4,000. You get to deduct $4,000 from your income. And the chattels inside it. Chattels are like the blinds, the washer, dryer, all the things that actually,
Carpets and
that
doors
stuff.
Yeah. Okay.
And that was 14%. But I think CRA changed the rules to 16%. Check with your accountant.
Okay.
I just know that I give everything to my accountant, and they manage all that part.
Yeah.
The only catch with depreciation is, when you sell this in a future date,
Yeah.
you have to pay the government back.
Okay.
Because it's like a form of RSP, it's tax sheltered.
Yes.
You're deferring payment, but they're going to get their money sometime or other. Unless you choose never to sell that property.
Just take the equity out of it.
Yeah.
Yeah.
Well, that's coming. You're ahead of me. You're ahead of me.
Yay.
So
Good.
this is the next profit center,
Okay.
and it's appreciation.
Mm-hmm.
Just think back 20 years, your parents' house. Do you know how much they bought their house for?
Yeah, not very much. It was like,
26 or something.
yeah, I think it was about, no, I don't think it was 20.
76.
It was around 70 something.
$76,000?
Yeah.
Wow. So your parents, and what year was that?
When I left home almost. Probably around, I was 15. So it was
20 years ago?
Well, they paid off the house before they left, so it's 25 years that they owned the house.
25 years?
Yeah, so they actually did pay them, they got it down to zero.
So what year did they buy this at?
So they would have bought it at, in
80.
1985, I think.
Okay.
Yeah, that's when they bought their house.
So now, it is now 2008.
Mm-hmm.
What do you think that house is worth now?
Well, they ended up selling it for $230,000, I think, is what they sold it for.
When did they sell it?
They sold it about 2 years ago.
So let's say 2006.
Yeah.
Look at that
Yeah, it's huge.
value.
Yeah.
And that's just them living in the house.
Mhm.
So that's appreciation, because all real
Wow.
estate appreciates. It's just that real estate's a long-term play, Teresa. And anyone who speculates, like does short-term flips, that's not investing. That's called speculating.
Okay.
Because they're banking on it, they're always going up and
Yeah.
then selling at the top. Well, real estate investing isn't like that. We like to look at a long 20-year plan. And in between that 20 years,
Mm-hmm.
prices would go up and down, up and down, up and down. But the thing is, real estate always traditionally
Goes up.
goes up and comes down, goes up, comes down, goes up, comes down, goes up, comes down. But the thing is, it never comes back down to where it was before.
Yeah, that would be great.
Do you think
No.
Do you think the house will ever go back down to $76,000?
No, I don't think so.
It'll never do that.
Yeah.
And so the last one is related to this. It's called reinvesting. Okay, reinvesting your equity. What happens is, when you sell your house, you're subject to capital gains because it's not your primary residence, it's an investment.
Yeah.
And so you're going to get taxed. Well, how do you take out money tax-free? You reinvest. So what you do is let's just theoretically say that instead of your parents selling the house for $230,000, they refinanced it.
Yeah.
Okay?
They brought the money in the home.
So the bank is going to allow you, and they had no mortgage? Okay. So that means usually you take the value of the house, subtract any mortgage payments remaining, and then you multiply it by 75%. Because the banks will loan you up to 75% of this value. And let me get the calculator. 200,000 times 75% is $172,500.
The funny thing is the house that they bought, that's how much the new house costs.
Yeah.
Wow.
So that's the equity the bank would have given them. That's tax-free money, and you basically have your house appraised, and then the bank appraises it, and they give you something called a HELOC. It's a homeowner line of credit.
Yeah.
It's secured against the value of the house, and you have a lower interest rate when you do that.
Yeah.
Versus a secured line of credit. Unsecured line of credit.
Yeah.
So just imagine your parents, instead of moving, chose to continue living in their home. They took the $172,000 and they bought
More real estate.
some real estate.
Yeah.
20% down. So $172,000 is not going to buy one house. You're going to do it so that you can buy maybe 4 houses. Okay? So I'm going to buy 4 of these things. Or more.
Yeah.
Depending. Oh, look at this. Here's 1, here's 2, here's 3, here's 4. And let's say you work all the 7 profit centers, so you're maximizing equity. Everyone gets equity day 1. You've leveraged it, so now this money is now worth 4 times the amount. So what I mean by that is 172,500 times 4. Because it's actually it's 20% down. You multiply it by 5. They control 1, 2, 3, 4. Let's go 5 houses because it's 20% down now. $862,500.
With the real estate.
$862,500.
Almost $1 million.
That's the portfolio they now control with their $172,500.
That's amazing.
Okay, and that's so they have equity day 1. They've used leverage. I would insist that they all have cash flow.
Yes. Yeah.
They get to enjoy principal pay down, write off all the interest. They get tax benefits, more interest coming, more expenses coming off. These houses, let's face it, they hold it for 5 years, 10 years. It's going to go up in value.
Yeah.
Just imagine if it does these.
Well, they were in Edmonton too.
Oh
Remember?
my gosh!
Yeah.
It went up really.
Oh wow.
And then guess what? At that point, so if you understand appreciation, there are certain areas in Canada right now where you're experiencing double-digit appreciation. Right now, CMHC, I think the standard appreciation rate is 10% per year.
Wow.
On your money. Isn't that amazing?
That's amazing. Yeah.
And so this happens for a few years. You get to go back to these 5 houses. You can do the same thing. Pull the equity out and buy more.
Yeah.
See how easy that is?
But I guess people get afraid too because they're thinking, okay, now I got these 4 houses, and then I have renters and all this stuff. So this is where you have like a team,
like a power
team.
team.
Yeah.
And that's
okay.
also in Find the Deal.
Yeah,
You go
okay.
through that, and you don't even manage this stuff. All you do is the money comes into your bank account magically. Every month, property manager handles all that.
Okay, yeah, because that would be most people. They want to just control everything too versus letting someone else. Yeah.
I don't want control. I just want the control of having the money come in my bank account.
Yeah. Okay.
And so this is how sophisticated investors manage their real estate portfolio.
This is not that.
This is easy.
Yeah, it is.
Totally
yeah,
easy.
Yeah.
Now, I've been practicing this for several years now.
Yeah.
And it's just very easy. It flows.